Hi guys, welcome back to Simple Stupid Finance, where we talk about complicated finance concepts in a simple way. In today's video, we're going to cover margin. Margin is a very popular instrument among institutional investors and recently became popular among some retail investors. You can make a lot of money with it or you can lose a lot of money with it, so please pay attention. So margin is basically when you borrow money with your investment assets as a collateral. What does it mean, right? Let's look at an example. Let's say you have $1,000 worth of stocks and bonds in your account, and if it's a margin account, you can go to your broker and loan $1,000 on top of it, right? Now with this loan, your buying power is at $2,000, right? So in here you're trading on the margin, right? Okay, so before we go further with the margin, we gotta cover a couple of terms, right? So first, let's look at the different types of accounts. So the first one is a cash account. It's the most traditional account when you can only trade the assets that you own, right? So if you deposit $10,000 into your account, that's it. That's the only thing you can do. Like you can buy stocks or bonds with that $10,000. The worst thing that could happen to you, you can lose that money, right? The margin account is basically when you can borrow money on top of the money that you have, right? So you should really make sure you pay attention to it because you can lose a lot and make a lot. Another important term to remember is a margin requirement. Is a requirement is a percentage of investor assets that are relative to the total position that broker wants you to hold. So for example, let's say your broker might say, hey, you know what, you gotta have a 80% margin requirement. So that means 80% of your total position have to be actually your own money, meaning like it has to be positions purchased with your own money, right? Some brokers might have 50%, right? It's not only dependent on the broker. Sometimes there is a regulation requirement by the federal government, so you have to make sure that you really understand all that stuff. All right, so the margin call. Margin Call, it's a movie made in 2011. Kevin Spacey in it, so just watch it. It's a pretty good movie. Watch it after this video, okay? So what is margin call? Margin call is when the broker asks you to deposit more money or positions will be liquidated. What does it mean, right? So that means like, let's say if the broker's margin requirement is 80%, right? And then the value of your assets went below 80% of the total position. That means the investor assets now worth less than 80% of the full portfolio. So then your broker will say, hey, you know what? You got to deposit more money into your account, right? Or you have to like transfer positions from some other brokerage account because now the broker is worried that you're gonna go bankrupt, right? Otherwise, if you don't do that, the broker might liquidate your position, right? And sometimes it can liquidate at a really bad price, right? So let's say if you breach your margin requirement and the market closed, the broker will try to execute your position in off the hours, right? And off the hours, the liquidity is so thin, the price is gonna move like crazy against you. So be careful. All right, another three terms to remember is initial margin, maintenance margin, and reg T end of the day initial margin. So this is different terms, right? You probably want to clarify it with your broker what they all mean, but basically you really should pay attention to the last one, reg T end of the day initial margin. That one is usually the strictest one, probably has the highest limit. So that's the one is when you like when the day closes, what's your margin requirement should be, because sometimes you might breach lower margins during the day because like the stock's volatile and stuff, but when the stock market closes, usually the margin requirement higher there. So please make sure with your broker what the margin requirements are. Okay, so let's look at an example, right, of a margin account. So let's say you have a $10,000 in your portfolio. This is your own money, right? Like you bought some bonds and stock with it. So then let's say if it's a margin account, right? You can, let's say you borrowed $8,000 from your broker, right? So now your total portfolio is $18,000 because $10,000 is your own stuff, your own cash, and $8,000 on top of it, right? So in the percentage terms, your portion is 55.6%, and the margin portion is 44.4%, right? So let's say this is one of the most popular brokerage accounts, and let's say your margin requirement is 50%, right? So you would think like, okay, it's not that bad, right? I'm 5.6% above the margin requirement, so I'm not that bad. So let's say what happens in 1 month, right? Let's hypothetically say that your portfolio went down by 17%. 17% over 18,000 is 15,000, right? So you would think not that bad, right? You can just wait it out. But you're in a margin account. So what happens with a margin account? That $3,000 gets subtracted from your $10,000 equity owned by you. So now your own equity only becomes $7,000, right? So now relative to the full portfolio, your own equity is only 46.6%, right? Because the margin portion didn't change. That's how much you owe to the broker. Broker doesn't take risk for you, right? Broker just borrowed you the money. So now, since you're below 50%, the broker might issue the margin call on you, and it probably will. So now your margin, so all you have left now is $7,000, right? And you started with $10,000. That means you lost 30%, not 17%, because your account was margin account. You know, high risk, high reward. Sometimes you lose a lot of money. All right, so the last term to remember is the margin interest. Margin interest is how much interest the broker will charge you on the margin loan. In 2020, in the beginning of 2020, the brokerages would charge from like 1% up to 9%. It's amongst the most popular brokers. I'm sure there are some less popular ones that go outside of this band. So basically, you want to make sure that you do your research before you choose the broker, because you want to make sure that you choose the one that has the lowest interest. Because sometimes, you know, those interest by like 9% interest will just eat your position. Alright, that was Simple Stupid Finance, guys. Please like and subscribe. And please make sure before you engage in any trading that you get an advice from a registered investment advisor, because this video is references an opinion and is for information purposes only. It's not intended to be investment advice. Seek a duly licensed professional for investment advice. So guys, be careful there. Thank you.